Hey everyone, welcome back to the Daily Gold Podcast. I'm speaking here with Dave Skarica of AddictedToProfits.net. Dave, I have to tell you, the gold stocks have kind of been confusing me recently, and let me tell you why. A lot of the names that I follow and some of the recommendations in my portfolio have done very well, yet if you look at these indices, mainly, GDX or the HUY, there's some companies in those indexes that are almost polluting the index because their performance is so bad. They're dragging down the overall index, and their performance is bad not because the fundamentals for the sector are bad. It's just because it's a tough business, and operationally they're missing expectations and so on and so forth. And it's very interesting because if you look at, technically, if you look at GDX or HUI, it just looks very, very weak right now. Yet there's, the juniors had a really good rise off their bottom in late December, and there's a lot of mining equities that have been doing well. Yet when you look at, the GDX or the HUI, which is kind of front and center, it just looks so negative. Can I get your take on that?
Yeah, I think you look at, there's been a couple large cap names that have performed very poorly. There's a couple that are in the midst of turning themselves into larger producers from kind of mid tiers. And that expansion usually requires a lot of consolidation, a lot of takeovers, a lot of share dilution when you do that. So you'll usually find when companies are in the midst of doing the takeovers and then rolling those properties and getting those properties into production, that can actually hit them, in the short to intermediate term. And like, I'm not going to give an example of a company at the moment, but a company that did happen to, perfect example of, was Agnico Eagle. Sorry, not Agnico Eagle. Sorry, Yamana. Yamana really lagged over the first half of 2011 as they kind of, took on, as a lot of these projects they took over started to go into production, and you had a lot of excess stock in the market because they had done a lot of using their share as currency to take over these projects. And then once things really started to ramp up, once they started making money, once it was obvious that these takeovers had worked successfully, Yamana really took off from about $11 to $17 a share. So that is kind of where we are, where we have this combination of a couple companies who have missed expectations, who are struggling a bit, and companies that are, have done a lot of these takeovers who are lagging for that reason. And they're kind of holding back these indices, as you said. Now, but on the other hand, too, what's really frustrating, even the companies that are doing very well, some of the royalty plays have taken off. As you just mentioned, I've had a couple of juniors and a couple of mid-tier plays do well as well. But then a couple of the large caps like that have done well are going nowhere, and they're seeing valuation contraction, to the point where they're trading at between 10 and 15 times earnings. And even with beating quarter after quarter after quarter, they can't really seem to catch a bid or move up in price.
Right. Now, before we get to the juniors, I'd like to get your thoughts on this because that's kind of what I talked about in my talk at PDAC about how valuations on the producers of stocks in the HUI, I mean, the index itself, and I went back and I calculated all of this, it's trading at 15 times trailing earnings. I believe it's trading at 12 or 13 times projected earnings this year. And the historical average is, I think, about 28 times earnings. So I just want to ask you, Dave, because I know you're a real historian when it comes to bull markets, is that when we're kind of in this wall of worry phase, is that typical where valuations kind of come down and perhaps, is it that point in the bull market where valuations kind of make a low or they're on the lower side before they start to move up? I mean, what are your thoughts on that in regards to what we're seeing now?
I think what happens is when you come off the bottom, you're very cheap, and then you kind of get this exuberance in the first move up. And I guess the example in equities would have been like 1982 to 1987. And then you have this period after like a big correction where you get the wall of worry. In the early 90s, for example, in the major economy, you had the Rust Belt of the Northeast, a lot of industrial capacity, went away. And you had, people worried about the economy right before the big boom of the mid to late 90s. And, the same thing happened then. The S&P, which had been trading well over 20 times earnings at before the 87 crash, got down into the low teens in 1994, right before the big move higher. And I think that's kind of where we are in this bull market. That for whatever reason, maybe perceptions over the European, banking and debt crisis, maybe people getting burned in gold stocks back in the 2008 crash, we still have this mentality that people aren't getting into the gold stocks, and they're kind of seeing this wall of worry, and they're not collapsing. They're more just in, a couple perform badly, but most of them, are in these trading ranges. And at some point, they got to break out of those ranges. Like, it'd be very difficult for me to see some of these things getting down to 6 or 7 times earnings. Like, that would be shocking to see. I guess it could happen because, as you said, we're already at 4 times 12 or 13 times earnings. So times forward earnings. But I definitely think we're in this kind of wall of worry phase, which can happen in the middle of secular bull markets, because usually in the middle of a secular bull market there is some kind of downturn, which because you need these corrections to wash the weekends out of the market, and then that worry can last for a couple of years. But I think we have to be getting closer to the end of that than the start of it.
And specific to specific to secular bull markets in the mining stocks, Dave, because you know more, but not to pat you on the back numerous times here, but you know more about that than I do. And if you go back to the late 70s, and also there was kind of that cyclical bull market, I think 93 to 96. What the point I'm getting at here is when you kind of get to the second half, or the last phase of a secular bull market in precious metals, there's no record of the large companies going parabolic. I mean, if you look at the Barron's Gold Mining Index the last 6 or 7 years, it performed well, but there's no parabolic move. Like, the best move those stocks made were actually the first 7 or 8 years. And again, if you go, from 2000 to 2008, the large stocks had a really great move. And since then, they've basically done, they've gone all over the place, but the net gain in the last 4 or 5 years has basically been nothing. So, what I'm saying is, if we look at history, should that tell us not to really have huge expectations with a lot of these large stocks? I mean, when the market gets speculative, isn't that when most of the money is directed, towards the, the juniors, the established juniors, the large developers, the exploration companies? I mean, what are your thoughts on that? And just to add on, I mean, if you look at the charts, the juniors have had a pretty good rise in the last couple of months. I mean, the CDNX made a double bottom. That doesn't look like it's going to new lows. You look at GDXJ, that doesn't look like it's going to go to new lows. It's down less than 1% today, while GDX is down more than 1%. So, I mean, could we kind of see a divergence taking place between the large miners and everything else?
Yeah, I think part of it is a unique a thing to this secular bull move, where gold is now getting harder to drill out of the ground. It's becoming more expensive. Most of the large cap companies are having decreasing reserves, and they've got to do increase the reserves through exploration or takeover. So I think that's because the quote unquote easy gold has been found. So I think that's part of the move. Secondly, you're right. I think the Barron's Gold Stock Index, if I'm correct, went up about 4,000%, or roughly 40 times, from the early 60s to its top in 1980. Well, if we take the HUI, whose low is roughly 40 times 40, that gives you about 1,600 yeah, 40 times 40 would be roughly 1,600 on the top. So really, that's only another triple or quadruple from where we are today. So you are correct, and they've already, gone up roughly 10 to 1 from their bottom. So you are kind of correct that in that second phase, the senior stocks may kind of lag. And then, when you get the more frothiness going into the market, it's kind of like the secular bull market in stocks in the 90s. Did IBM go parabolic? Did all the big Dow stocks go parabolic? Even as well as Cisco and all the large cap tech stocks? No, it was all the smaller kind of internet, more speculative plays at the tech bubble that went parabolic. And I think that's what you're going to find here, that these kind of smaller producers or mid-tier companies or junior companies are the ones that are going to have the really, really big move. Not saying that you won't do well in the seniors as well. And because I think this is a more intense bull market than the bull market of the 70s, I'm looking for more than that 4,000% gain. I think this one might see higher prices in the stocks. But you're right. It's really, I believe, as you just said, that the upside is going to lie in the more mid-tier, the junior companies. Part of the reason is with these bad earnings misses on the large cap companies, what's that showing is that it's really difficult to run some of these, like, conglomerate, like big gold companies. And there was a reason maybe there was only a handful of them before this cycle in the market. I think, the Agnicos and the Kinrosses and those companies that have missed, they're finding out kind of the hard way that, you know what? Being a 10 property company is a lot more difficult than being a 2 or 3 property company. And that might gravitate, and that may also be why these mid-tier companies are going to kind of outperform, because as long as you can manage your 1 or 2 properties properly, you can do really, really, well. So I agree with you 100%. I'm really looking for the outperformance to be in the smaller and mid-tier companies. And like I said, if we follow the track of the 60s to 70s bull market, there still could be another quadruple here for the large cap companies. But I think there'd be a lot more in terms of gains in these smaller and mid-tier companies.
Right, yeah, and I really like your answer there, because you gave a lot of fundamental reasons. I mean, there's a lot, as you said when we started this bull market, you could count on your hand the number of major companies. Now there's companies like Yamana that have grown into that kind of major status, and like you said, they're finding out it's very difficult to run a major mining company, and at the same time the price goes up, and then you have a boom in money being spent on the exploration side. I mean, wasn't there kind of a junior boom? I know there was a junior boom 93 to 96, but there had to be something kind of in the early 80s. I mean, the gold stocks, even though gold had a
it was the late 70s to 80s. No, it was actually probably, out of all the booms, the one that happened in the late 70s might have been the biggest. Maybe it wasn't in terms of the most of money made in market cap, because inflation, things have gotten bigger, and the financial markets have gotten bigger. But in terms of like the stories, like in terms of companies that were like 50-cent companies that went to $20, $30, $40, you see all kinds of little stocks like that happened in kind of the late 80s and that time period. And it was just absolutely insane what was going on at that time. Because remember, again, like adjusted for inflation, even bogus CPI numbers, we're talking $2,500 gold in today's money, probably for real inflation closer to $4,000 or $5,000 gold. So just imagine what that did to the stakes in these like junior companies back in the late 70s. And there's actually another point I'd like to make about the gold stocks, and this is actually something that's unique to now too, is we're getting some value in them in terms of dividends. When I was entering the gold arena in the mid-90s to late 90s, and then in the early 2000s, gold stocks were really cheap, you could never get any kind of income out of a gold or precious metal company. That they were always paying like the minimum just to stay on an exchange, like, paying 1 or 2 cents a share or nothing at all, and yielding like, a tenth of 1%. But now there's all kinds of gold stocks, and this may not seem like a big deal, but that yield 1 or 2%. Like most of the large caps, even a company that struggled like Agnico has actually upped their dividend to 20 cents a quarter. So what we're seeing is there's actually some income now. And you might look at it and go, it's only 2% a year. Well, a 10-year bond gives you 2% a year, and you can buy a stock like Agnico or like Kinross and get 1 or 2% a year, basically get the same yield you're getting on a 10-year bond. Plus the stock's kind of sold out and probably at the bottom of its range. And even if it just goes up 5% a year, you're going to be out doing a 10-year bond by 3 or 4 fold. So like I think right now, kind of the income factor, we have all these companies now that are yielding at least a couple percent, also makes it a unique time to kind of look at some of these gold companies.
Yeah, and the dividends, that's something that you've been talking about that for a couple of years, and now we're finally starting to see these companies pay dividends, and it is a difficult business. So maybe with the excess cash that they have, it's not always prudent to take that money and try and grow, because if you're producing a couple million ounces a year, it's just physically and numerically impossible for these companies to continue to grow. So I think that makes a lot of sense, paying out dividends.
If you're looking for a catalyst in the industry, Mark Faber had an article on this, and I'm writing an article that I don't want to say similar, but like the themes are all the same. Is that why haven't these stocks moved? And there's new, like, what's going to take it? Number one could be more pro shareholder type investors. Get some Carl Icahns involved here, right? Because the problem with the gold industry is that we still have a big old boys club. We have a lot of geo types running companies, and maybe we need more financial guys who understand financial markets better to run some of the larger cap companies. So that's number one. Number two is maybe make them into income producing plays, kind of like oil trusts were in Canada. That, okay, like you said, instead of doing takeovers, if I'm, company ABC and I trade at $20 a share and I pay a 20-cent dividend, why, instead of spending that 80 cents a share on taking over companies, let's give people some income. Let's pay out 60 or 70 cents a share and have this thing yielding 3, 4, 5%. I think something like that along those lines has to happen. Either make these things, more income type share, producing investments, or you need some more quality management to really streamline the overhead costs and that sort of thing. But something like that kind of launches and get the average person involved, And I think part of the thing that will get the average person involved, and I've always said this, and this goes for the large and small cap gold stocks, is you're going to need a debt crisis in probably the United States. And when you get a debt crisis in the United States, the average person does not have a huge amount of wealth, saved, because the average person is still quite indebted. And, let's face it, the average investor is quite unsophisticated. So what's going to happen is the average person is going to look at gold. By that point, when a debt crisis kicks in, gold will probably already be trading at $3,000 an ounce or something. They'll look at, like, say, Barrick, even if Barrick's, gone up 50, 60% from now, at a $2,500 to $3,000 an ounce gold price, they'll look at something like Barrick, go, you know what, I'd rather buy a share of Barrick at $70 a share, or a share of Kinross at $15 a share, wherever these stocks are, and then buy gold at $2,700 an ounce, because I just don't have that kind of capital on hand to do it. So I think the nature of these gold stocks being undervalued is going to help them, because it's going to attract capital at some point, because when the masses get involved, anybody can go out and buy, a $20 a share stock, or, or $2 a share, mid-tier company or something like that, where not everybody's going to be able to afford a $3,000 an ounce gold coin.
Yeah, I think that's an excellent point. And before we close, Dave, I know you had some thoughts on China, so let's hear them.
Yeah, well, we've seen this consolidation in gold and gold stocks and commodities. And the day we're doing this, which is March the 12th, we're seeing a down day in most commodity special metal prices, because China had some weaker than expected exports. Of course, our imports are way up, so it's not really reduced demand, because it looks like they're making up for that decrease in external demand with internal demand, which I think is going to a long-term trend that's going to continue. But anyhow, the key about this is it looks like to me that the Chinese and the Indians are both going to start some kind of monetary stimulus. And because they did most of the fiscal stimulus like 4 years ago in 2008, 2009, I'm looking for the next round of their easing to be more monetary based, because both countries, especially India, has higher interest rates than the rest of the world. Remember, what's amazing about this move in gold and metals is that a lot of the upturn has happened with, on the monetary side, China and India remaining quite tight. So now that they're going to start loosening, I think it's going to happen in the second quarter. Everyone looks at, the economy is weakening in China. They just reduced their growth expectation for 7.5% this upcoming year. But what's going to happen is, the market does forward look. So when, and they used to have that saying in the U.S., you don't fight the Fed. So when the Chinese central bank and the Indian central bank start to loosen monetary policy, I think that is when you can see the next move up in kind of these metals. And I expect that to happen sometime in the second or third quarter.
Yeah, that's a great point. And also, I think you made the point we have a significant amount of elections this year around the world. I mean, obviously, the U.S. being the big one, but where else do we have elections, and how might that impact monetary policy?
Well, there's a lot of, I think Germany has elections. There's a lot of European nations with elections. And I think what ends up happening with that is you keep monetary policy loose, because you don't want to take the chance of having a recession going into an election. Not that your central bankers are supposed to be politically motivated, but I think we can see that in terms of tightening, it's probably a lot easier to do it in the second or third year of a presidency than it is in that last year. So I expect to see loose monetary policy all over the world for the next year or two. Personally, I think it's going to happen until the market forces these central bankers' hands. Look at Japan. Japan's had it for 15 years, and the only reason they really haven't tightened is because the market hasn't forced them to yet.
And I know we're carrying on too long here, but the yen is actually starting to fall apart. So maybe we could close on that. I mean, could that be? I remember there's a great book by John Murphy about technical analysis. I think it's intermarket analysis, and he's basically saying that everything that's happening in Japan is just preceding what is going to happen in the U.S. And if you look at the yen, I mean, the yen has fallen from about, I'm looking at a chart here, from about 131 to 121 in about 5 weeks. So, I mean, could this really be the beginning of, I hate to use the term crisis because it's so strong, but I mean, that's quite a big drop there. What are your thoughts on that?
I've actually been bearish on the yen since last year, and we actually have done well on a trade where we bought the inverse yen ETF, because I thought that isn't just a crisis right now. That's also a devaluation the Japanese government wants to happen, because again, Japan has a lot of the world's top tier exporters, and they want those exporters to become more more competitive again. I think the real crisis would be happening if that yen drop coincided with a real rise in long-term interest rates. I think that was where your crisis would happen. I think the yen could still drop another 20%, and if the yen went back to 100 to 1, I think the Japanese authorities would actually would be pretty happy about that. But no, I agree with you. Demographically, Japan's probably about 10 years ahead of the States. The States has more, obviously, positive immigration, policy, so you can't compare them entirely. But if you actually look at the financial markets, it seems that Japan's about 10 years ahead of the U.S., that they had their bust 10 years prior. They had their, really, well, there was a banking crisis. Really, it was about the mid to late 90s. It took hold, 7 or 8 years after the first drop in the market in 1990, similar to the U.S., that after the first drop in the market in 2000, the financial crisis happened 7 or 8 years later. So, no, they're very, very similar in paths. And again, it seems like you just mentioned, Japan is 10 years ahead of them, 10 years ahead of the U.S. So I think you'll get that devaluation at some point as well. And I think that's a few years off, though, in the United States. I think what happens is probably the U.S. dollar is going to hold up because of the problems in Europe. And obviously Japan's devaluing now, too. And then probably 3 to 4 years from now, I think the Europeans are ahead of the Americans in terms of solving their fiscal deficits, the structural deficits. And then when they're kind of being sorted out and the U.S. hasn't sorted that out, that probably sets the precedent for the U.S. to really, really devalue. And you got to remember, it's not all just a crisis. Like a devaluation of 20 to 30% on the dollar would probably also kind of be wanted at the same time, just like it's wanted in Japan.
Right. Okay, on that note, Dave, we have to leave it there this time. But thanks so much for your great insight, as always. Dave Skarica of addictedtoprofits.net. And thanks so much, Dave. Look forward to talking to you again soon.
Thanks for having me.